cash flow forecast becomes useful when every material number has an owner, evidence, and a date for review. In this video, we will build a practical weekly review around a 13-week cash flow forecast. The forecast estimates when cash may enter and leave the business. It is management information. It does not replace bookkeeping, statutory accounts, or current bank records. 13 weeks is the working horizon used in this example. It is not presented as a legal requirement, and the forecast does not prove that a business is viable, safe, or insolvent. Its value is visibility. It can show which assumptions drive the closing balance, when pressure may emerge, and which questions need checking. Use fictional figures on screen. Do not show customer, supplier, employee, bank, or tax identifiers. Begin with cleared cash that has been reconciled to the accounts used by the business. If money is restricted and cannot be used for normal payments, keep it separate. Then list expected receipts and payments in the week they are expected to clear. A sales invoice date and a bank receipt date are not the same thing. The same applies to supplier invoices, payroll, rent, finance payments, and tax. Keep material cash movements visible. Do not hide a large payment by netting it against an unrelated receipt. Add a source note to each material line, for example, an invoice list, payroll report, direct debit schedule, contract, or current correspondence. The closing cash estimate for 1 week becomes the opening estimate for the next. Reconcile the actual opening position again at every weekly review. The forecast is only as reviewable as its assumptions. For each material or uncertain line, record the amount, expected week, evidence, confidence, owner, next review date, and change trigger. Use consistent confidence labels. Confirmed might mean supported by a current record or explicit commitment. Likely might mean there is reasonable evidence, but timing remains uncertain. Uncertain means the amount or timing needs further checking. These labels are internal review aids, not guarantees. For customer receipts, note the invoice, due date, collection evidence, and whether the amount is disputed. For supplier or tax payments, use current records and any confirmed arrangement. Never insert a receipt, funding line, or deferred payment merely to make the closing balance positive. The register should make it clear who will verify the assumption and what new information would change it. The base case should reflect the current expected outcome using the best information available. It is not the sales target, and it is not the outcome the business hopes to achieve. The downside case changes name drivers that could reasonably worsen cash timing. For example, 3 identified receipts may move from week 4 to week 6, or an unavoidable cost may arrive earlier. Keep the opening balance consistent unless there is evidence for a different starting position. An upside case can test earlier receipts or lower costs, but it must not hide a base case shortfall. Avoid applying an unexplained percentage to every line. State the operational reason for each change and identify the weeks affected. The comparison should show the assumption, the evidence, and the cash effect. It does not predict which scenario will occur. Choose a fixed review day. Replace the completed week with actual cleared cash. Reconcile the bank position. Explain material differences, and roll the horizon forward by 1 week. Preserve the prior version and add a short change log. For each material variance, ask 5 questions. What was expected? What happened? Is the difference timing or permanent? Which future weeks change? Who will verify the revised assumption? A receipt that moves from Friday to Monday is usually a timing difference. A cancelled order changes the amount. A payment missing from the model is a completeness problem. These causes require different corrections. This weekly cycle improves cash visibility and management information. It does not turn uncertain estimates into facts, and it does not guarantee funding. Profit and cash are also different measures. A profitable sale may not create usable cash before wages, rent, or tax fall due. A projected shortfall is a prompt to verify the data and decide what needs discussion. It is not by itself a legal conclusion about insolvency. Check whether receipts are genuinely expected, whether liabilities are complete, and whether proposed actions are within the business's control. Warning signs can include receipts, moving later every week, repeated missed payroll or tax assumptions, reliance on unconfirmed funding, or payments removed without evidence. If a company may be unable to pay bills when they fall due, or there is uncertainty about directors' duties, use current official guidance and seek appropriate professional advice promptly. If the business is having difficulty paying tax, use HMRC's official payment problems route. A forecast entry does not change a tax deadline or create an arrangement. Decoded does not diagnose insolvency, recommend finance, prepare accounts, or decide what action a director should take. Use the free cash flow and KPI dashboard to organize high-level figures and identify preparation gaps. It provides browser-based output with no human review. It does not provide an accounting, funding, or insolvency conclusion. If the figures are already organized and the business wants a structured completeness and gap review, the cash flow and KPI review is a separate paid preparation service. It is not audited accounts, tax advice, funding approval, legal advice, or insolvency advice. No turnaround promise is made in this video. Start with the free dashboard. Keep the weekly forecast, assumptions register, source notes, variance log, and dated prior versions together. Use appropriately qualified professional support for accounting, finance, legal, tax, or insolvency questions. The goal is disciplined preparation, clearer inputs, visible assumptions, and better questions. It is not a promise of a particular business outcome.